Let's connect then with Sunil Subramaniam. He's the Managing Director, CEO, Sundaram Mutual, and now joins in our studios. It's been a long time and good to have you back. And lots has happened with the equity markets as well after that tumultuous month of April. For now, May didn't get off to a heady start, but now some semblance of normalcy. Are you reading into this move as a decisive pickup, or still is the undertone of the market looking rather weak, given the kind of macro backdrop we're placed with?
Yeah, I think the undertone is still quite weak. These are not dead cat bounces, but more relief rallies, right? Some things which are oversold are getting bought. There is domestic liquidity still with mutual funds which are there to buy. But I would still say that overall the undertone is still weak given the uncertainty around the advanced countries. I think that's still, a mixed bag, I would say, both in terms of the fact that the crisis, Ukraine-Russia crisis is not anywhere close to a solution. The decision to expand NATO by getting Finland and all do is not going to help that. And US also, the signs that they overplayed their rate cut card and the liquidity card, right? It's clearly coming through now. They have created a stagflationary scenario, and there are talks about a recession actually happening in the US, which is not very good news. So the level of uncertainty, I would call it a geopolitical economic uncertainty, is going to be an undertone for the markets in the near future.
You know, when we had interacted in the month of March, you had spoken about doubling your SIPs for the next 6 months. Looking at the current setup, what's the advice for SIP investors?
I think that advice is excellent and remains strong, because I think the subsequent volatility, as you know, in SIP, in addition to power of compounding, is the rupee cost averaging. And I think all this volatility has meant that every single installment, if they had actually doubled, they would be actually sitting on a lot of gains. So I would say continue with that thought process till Diwali. The next 6 months, I think the volatility will be there, and you should have a heightened level of SIPs to take advantage of this volatility. This is not the time to commit lump sums, because in terms of sectors, see, I'll tell you why I recommend this SIP, because you're doing it through a mutual fund, you're diversifying. Because what FIs are selling, which is the pressure, is large caps oriented, but the small and mid caps are also correcting, but they are the ones which are going to bounce back. So you can't just go and buy that which has fallen the most. That's what a simple theory. Best to stick to the SIP route.
Good morning. This is Nantar also joining in on the conversation. Now, there are reports that are coming in that the cash levels have reached where it was at 9/11, post 9/11. Forget Lehman Brothers, great financial crisis. That's the kind we're talking about. Brokerages have also started to see much less business. We're seeing that as well. So, with what's going on, equities falling out of favor, what should be the plan of action? You're saying only SIPs?
No, see, when I say SIPs, obviously that's because it's for the monthly income category, those salaried class and all of that. For somebody else like a HNI who's sitting on the cash levels, right, a staggered deployment, which is not necessarily a regular SIP, but looking at a base level of market, and for every correction you top up your investment is the best way to go, because it's a very funny situation that at a time when I would say the Indian economy's outlook is actually looking better on a medium-term basis because of all the capex, you're seeing capacity utilization come back up. I would say the news on the Indian economy is actually reasonably good, but at the same time the markets are correcting. So it represents a very funny situation that we keep talking about economics and markets being in sync with each other, but I think we are going to see a phase where newsprint on the economy will continue to come out good. GST collections, everything will look good, but the markets are not going to immediately respond and people will be puzzled. So it's best from that perspective to stagger the investment into the market gradually over a period of time. Obviously, you mentioned about the credit and the debt markets. Now, interest rates in a rising scenario obviously is not the time to lock into medium-term debt. So if at all you do any allocation to debt, you've got to keep it short-term into the liquid overnight funds, that kind of a category. So in the absence of that asset class today, right, it's not that earlier, when equities was down, they would put fixed income. But today, both those asset classes are challenged, and gold is also going nowhere. So to that extent, keep faith in equities, because when the bounce back comes, that will still come back and help you with the gains.
Now, But they also say, right, that use dips, corrections to fix your regrets. What did you do in the kind of correction that we've seen in the last couple of trading sessions?
What we've done is basically it's in the banking and financial services space that we've been very happy to see the correction, because that remains our top pick as a sector and we have been accumulating that. So across our funds, if you see banking in the BFSI space, banking, NBFCs, that's been the biggest thing, and we've been buying good quality stocks there whenever there has been correction. So that's been the one significant thing where we actually have welcomed this whole volatility, because what we've been bullish on in the banking thing, I think, has actually come to play out, that the correction, because a large portion of the large cap index is in that space. FIS selling is generally across the board. It's not coming and selling a specific sector, they're selling India. So to that extent, we are getting, we believe, good quality financial services banking stocks at reasonable valuations, and that's what we are accumulating.
I see recent buys in the form of HDFC Bank, and even something like a Max Financial Services. Sunil, I wanted to understand from you as well, what are the recent sells? Where is it that as of now in this market environment you believe one should be avoiding from a long-term perspective?
So I think given the whole commodity thing, I think the FMCG space looks challenged, because you're not going to be able to pass on any of the commodity increase in a market where people are still not going out and buying stuff. So in the short run, FMCG is definitely something that we are not great on. The other place where a little bit of correction has happened in terms of the growth outlook is the IT space, right? Because of the US getting into a potential recessionary scenario, IT business, and the Nasdaq fall is also reflecting that. So IT is again somewhere where the valuation, I think, had overreached themselves. So why we believe in the quality of the companies, I think the prices today are yet, there is still some correction possible. So IT is something where we are cautious on in this current scenario. The third aspect is pharma, which had a great run because of the COVID crisis. Now that with COVID easing up, we believe those pharma valuations will also come to more of normalized levels from the current levels. So these are the three sectors where I would say that we've been doing profit booking, if that's what you want to call that.
Okay, fair enough. And Sunil, what's the outlook when it comes to the kind of tremendous move that we've witnessed within the metals basket? Of course, there are a number of triggers. The reopening of China, etc., seems to be fueling that move. But that this morning we were discussing is a positive as well as a negative, because from an India perspective, it doesn't bode too well. How are you looking at that dynamic?
We would still be underweight the metals pack, because if there's a US recession, that's not going to be great for the metal commodities, right? So there was earlier hope, if you remember, that US there would be a big infrastructure revival, and metals ran up partly on the back of that. Second is in China also, we still have to see how this latest COVID wave pans out and goes through. So to me, metals have discounted a lot of the future and the rally has happened. So going forward, I don't expect this to sustain in a very big way. So I would say that we are underweight metals at this point in time.
You're underweight in metals at the moment. Sunil Subramaniam, the other point, earlier this week we saw JP Morgan saying that the worst is over when it comes to the Chinese consumer tech stocks. Then globally, we've seen a comeback, right, of these kind of tech stocks. Yesterday's overnight action on Wall Street was by Apple, though you can't call it a startup. But for the new age listed companies that listed recently, they started to see buying, whether it's a Paytm, a Policy Bazaar, even a Nykaa has started moving up. Zomato still has to play catch up. Would you say these levels are now attractive? Would it be something you would consider?
Yet. We would like to have a little more correction, because I think a lot of the hype and the froth, it's gone. But I would still say we would like to wait a little bit more, because traditional models don't work with these companies, right? You can't do discounted cash flows, and so economic recovery, the digitization, people changing their methods of buying, all of those which were basically factored into these kind of model stocks, right? We have yet to see that play out in reality. So for us, I think we still want to wait and watch on these new age plays and see where the dust ultimately settles. They are good quality companies, there's no doubt about it, but at the current prices, we are still a little bit hesitant. So we would still wait for a little more correction, perhaps, to get that greater comfort around these space.
I see in your top 5, none of the Adani names are there. Is that going to change?
Well, I can't talk stock specific, but I think actions speak louder than words.
A lot is also being said these days about, the IT company valuations. Last 2 years, they have clearly been the market leaders, the IT pack at large. But there seems to be a blue chip fatigue that had started to set in. How would you approach the IT pack? Because, that is always been the favorite for the stock markets for a long time now.
So, one of the reasons that IT had this great run up was one, of course, was the liquidity where people sought safety. FIIs get comfort from IT because they understand the underlying businesses from their countries, so they get a better sense. Though it's an emerging market stock, they know that the business is from the developed world, which they understand well. That was the second reason. The third reason for this was that there was a revival expected in the US, and because the COVID crisis had given a big push forward to digitization, to the Internet of Things, to cloud computing, they expected the end user industries to rejig their whole, and work from home was also adding to that. So there was this huge hype that this is like a Y2K moment for IT, and that's where that run up happened, right? That was all very good while it lasted. While the fundamental business model of the IT companies remains sound, the fact is that the US overplayed the rate cut card and actually created demand-based inflation and are triggering a stagflationary, recessionary environment. In that context, how much would your end user companies really go and do all those mega IT-related backbone changes which was going to benefit the Indian IT companies is the question mark, and that's what triggered the correction. Especially when it comes to blue chip IT, they deal with the blue chip as customers, right? So the second aspect which comes in there is that now that the dollar has started to strengthen, historically you say that a depreciation of the rupee is favorable for export oriented and IT being there, that is favorable. But what is happening, you see, is that two things happen. One is that in these blue chips, they have active treasury management. So actually they tend to go and hedge out. So all the gains which you see from a depreciation don't actually translate to bottom line because they have hedged it as a risk-based measure, one. Two is also the customers being really the top companies of the world there, they renegotiate prices with the IT based on the depreciation. So that story that depreciation is very positive for IT and exports is not fully necessarily playing out. That's one of the reasons you've seen a cooling down in terms of the business growth model, and IT is now migrating back to a safety oriented play, whereas post-COVID it had actually switched from its safety orientation to a growth play. So I think that balance now IT is good. It's stable, but it's not going to be that runaway sector which it was anticipated about, say, 18, 24 months ago.
Okay, so that's how Sunil Subramaniam is approaching the markets to make volatility his best friend. Thanks so much for being live with us today.
Thank you.